Welcome to episode 13 of the SaaS Report. I'm your host, Matt Aird, founder at Sales Science, and today we're going to be looking at Klarna's plans to go public. They've filed documents with the SEC around IPOing in 2025. We'll also take a look at Salesforce and the recent announcement that they'll be hiring 1,000 salespeople to take their AI agent product to market. And then finally, we'll wrap up with a look at Klaviyo's journey from early stage SaaS startup through to multi-billion-dollar public company. But first, let's get to the news. Monday.com has released Q3 earnings, and the question I have for them is growth getting harder to come by? So they reported Q3 numbers last week. They had 33% ARR growth year over year, adding $247 million in net new ARR, with 60 million of that being quarter over quarter growth, right? So 60 million added in the last 90 days. But it is starting to look like that growth is getting harder to come by. This is the 12th quarter in a row for Monday of decreasing ARR growth rates, right, year over year. As we can see in this chart here, right, there's been a steady trend downward over the last 12 quarters. On top of that, CAC payback increased 10% year over year, so now up to 29.5 months. Magic number came in slightly softer than last year as well, so it's 0.45 versus 0.5 for Q3 last year. Free cash flow margin was also down slightly, but still really strong. So that came in at 27%. Still very healthy from a rule of 40 and a rule of X standpoint. So rule of 40 came in at 65, rule of X came in at 98. But share price was down off the back of this announcement. So down about 20% from the highs leading into the Q3 announcement. They're currently trading at 13 times ARR. Appian released Q3 results as well. They had a really strong Q3, so they grew ARR 19% year over year and reduced operating loss from 15.2 million down to 7.1 million. Also reduced free cash flow outflows. So in Q3 of last year, free cash flow was negative 65 million. They've cut that down to negative 8.6 million. So really good progress over the last 12 months there. Maintained really strong NRR, so that's coming in 117%, same as Q3 from last year. Pushed gross margin up as well, which is a great sign. So that grew from 73.7% to 75.9% in Q3 this year. This isn't obviously financial advice, right? We don't do that here, but they look like a buy to me, right? They're at 500 million in ARR, growing at 20%, really strong net revenue retention, and it looks like they have a really clear pathway to cash flow break even. And they're only trading at a 5.3 times ARR multiple right now. So I don't know, it seems cheap to me. Let me know if you think I'm missing something obvious when it comes to Appian. Cloudflare added more than 11,000 net new customers in Q3 and also added $116 million in net new ARR. That takes them to a $1.72 billion run rate, but growth has slowed slightly compared to Q3 of last year. So ARR growth of just 28% year over year versus 32% for Q3 of last year. Because of that, go-to-market efficiency metrics are also down, right? We had magic number reducing from 0.67 down to 0.74, and CAC payback increasing to 23 months from 21 months a year ago. Operating margin is up substantially though, so that grew 40% year over year. That comes from a reduction in all of the major OpEx categories. So R&D dropped by 4.5% as a percentage of revenue. Sales and marketing down about 3.8%. That also flowed through to free cash flow as well. So that's up almost 30% year over year to $45 million for the quarter. So pretty good quarter from Cloudflare. Share price didn't move much off the back of that Q3 announcement, despite the earnings beat. That's probably because they're trading at the high end of ARR multiples for the SaaS companies that we track. They're at an 18.3 times multiple right now. Amazon reported Q3 earnings, and that means that we get a little insight into how the AWS business unit is performing. And what we saw through AWS was a massive jump in operating income year over year. So operating income increased from 6.9 billion to 10.4 billion dollars for the quarter year over year. And a lot of that comes from an increase in operating margin. So operating margin for the quarter for the AWS segment came in at 38% versus 30% from Q3 of 23. And then on top of that, sales or revenue grew 19% as well, up to $27.5 billion for the quarter. But the story of AWS, it becomes really interesting when we zoom out a little bit, right? So in Q3 of 2015, AWS contributed just $2 billion in sales for Amazon, right? And about $428 million in operating income. So fast forward to today, so we're talking, what's that, 9 years? Revenue is up 1,200% and operating income is up 2,300% in the last 9 years. So that gives AWS a compound annual growth rate of 33% over the last 9 years, right? Now, if we look at AWS as a standalone business, right? Obviously, we know it's kind of part of Amazon, but if we were to take AWS and list it as a public company itself, right? At a kind of conservative 30 times earnings multiple as a standalone business, AWS would be worth $1 trillion, right? We've only got a handful of trillion-dollar companies. If AWS was a public company outside of Amazon, it would likely be one as well. So just incredible growth there from a business doing, $2 billion in revenue 9 years ago to potentially having like a standalone market cap of $1 trillion is insane. So Klarna has confidentially filed documents in the US to go public. And we've talked about Klarna quite a bit on the pod already. They've been making a lot of headlines recently for their use of AI internally. So in February of this year, they announced that they were introducing an AI agent to handle a lot of the customer service requests that the business was getting, right? And some of the headlines from that AI deployment was that in February of this year, they reported that their AI assistant had had 2.3 million conversations, and that represented about 2/3 of Klarna's customer service chats, right? And it's effectively doing the equivalent work of about 700 full-time employees. They told us that the customer satisfaction scores for this AI agent were on par with its human peers, and it was more accurate in error resolution, leading to about a 25% drop in repeat inquiries. Customers were able to resolve their errors, right, in less than 2 minutes compared to 11 minutes if they had to use a human agent, right? So really interesting case study there. I think most organizations in the world that are interested in kind of like AI and these AI agents will know about this Klarna case study, right? This was one of the first kind of real life instances that we got of AI being able to complete work at or above the level at which a human has been doing it previously, right? So that was kind of news story number one for Klarna this year. Then in September, Klarna was back in the news again, and we reported on this on the pod when they announced that they were replacing Salesforce and Workday internally with AI applications that they were developing themselves, right? So they were going to rip out these large systems of record on both the CRM and the human capital management side and the financial side, and they were going to develop their own solutions internally using AI. And this was part of kind of the cost-saving mission that Klarna was on to get through to positive operating income, cash flow break-even for the business. So the CEO, Sebastian Siemiatkowski, I think is how you pronounce that name, came out at the time, and he said that there are large ongoing internal initiatives that are a combination of AI, standardization, and simplification. As an example, we just shut down Salesforce. Within a few weeks, we'll shut down Workday. We're shutting down a lot of our SaaS providers as we're able to consolidate, right? So second news story of the year, right? Really big news. It was interesting for us, when we typically think of platforms like Salesforce and Workday, you think of these things, especially in the enterprise environment, these are things that you can't switch off, right? You need these systems of record for compliance purposes, right? To make sure that the financial reporting that you're doing is accurate, the forecasting that you're giving investors is accurate, to make sure that you're paying your people correctly, right? All of these things are super important, and these large SaaS applications or systems of record help you to do that. So interesting story there. Now, finally, third story of the year for them is that they've announced plans, obviously, that they're filing to go public. So we got to look at some of their financials. So in the first half of 2024, they generated $1.2 billion in revenue. They got 50% gross margins after accounting for processing fees, funding costs, and consumer losses. And so when we look at that business, right, fairly similar to a business like Shopify, right, that we track. Shopify operates on about 51% gross margins. In the first half of the year, they spent about 42% on OpEx. So that's broken down to about 13% on R&D spending, 10% on sales and marketing. They break out customer service, so 8% on customer service and 12% on G&A. So on an adjusted basis, they're reporting operating margin of 5%. On a GAAP basis, that's negative 2% operating margins. Okay, so on a $1.2 billion in revenue, you're looking at $60 million in adjusted operating income for the first half of the year. So at the moment, they're at about a $2.4 billion run rate, right? Revenue's growing 27%. Revenue in the US, which is their most important kind of strategic market, is growing faster. That's growing at 38% year over year. And so what they've announced is they've got plans to IPO at somewhere between 15 and $20 billion. So let's kind of try to go through an exercise here and sense check whether we think that that's going to be possible, right? Now, if we assume that the IPO takes place in kind of the middle of 2025 and they maintain their current growth rate, they should be somewhere close to about a $2.8 to $3 billion run rate, right? That would give them about a 5 to 7x revenue multiple if they were to achieve that kind of $15 to $20 billion mark. And so let's take that and see how that stacks up to some public comparables, right? So Shopify, as we talked about before, might be a decent comp, right? They're a business that operates with a very similar margin profile, gross margin profile, right? So Shopify generates about 50% gross margins. Shopify obviously has a higher quality revenue mix. So about 25% of Shopify's revenue is recurring subscription payments. The other 75% comes from kind of transaction fees. And they obviously don't have as much kind of like interest rate risk or consumer kind of credit risk that a business like Klarna would have, right? And so Shopify at the moment is trading at about 16 times revenue, but they generate, a 10% operating margin on a GAAP basis, and Klarna is still has a negative operating margin on a GAAP basis, right? They're growing at about the same rate as Shopify. So if Shopify is getting a 16 times revenue multiple, would we feel comfortable with Klarna getting a 5 to 7x multiple? I mean, probably, right? That feels okay. You're probably buying Klarna earlier in the journey. You're getting it for about a 50% discount in terms of revenue. If you continue to see improvements towards operating margin and cash flow break even, and they can maintain their growth rates in the US, then I think there's an interesting story there. Affirm is another public company, probably a better public comp, right? They play in a very similar market. They're in this kind of like buy now, pay later space, but they operate that in a slightly different way. So the way that consumers are charged is based on an interest rate as opposed to some fees, which are kind of like less clear to the consumer in terms of what they'll be paying, right? Regardless, very similar kind of business model, right? Affirm's valued at $20 billion in the public markets. They did $2.3 billion in revenue in financial year 24, but they're not as sound financially. So they're roughly the same size as Klarna, but they had operating margins of negative 25% last year compared to Klarna's negative 2%. But they are growing faster. So in Q3 of this year, Affirm reported 41% revenue growth. That's compared to the 27% revenue growth that we get for Klarna, right? So with those two public comps, I think that if Klarna can continue on this trajectory, right, maintain high 30% growth rates in the US, continue to move towards operating income break even or cash flow positive, they should be able to achieve that $15 to $20 billion price tag. Now, this is the first time that I've had a look at one of these kind of buy now, pay later fintech businesses in depth. And one of the things I found interesting is this metric that Klarna calls their take rate, right? Which is, you could think of Klarna's value proposition to merchants or to retailers as helping them to sell more stuff, right? If you own a retail store and your customers come into the store and they can, take the items with them now and not have to pay for them yet, right? So pay for them over 4 weeks or whatever it is, then that's going to help you as the retail business sell more stuff. The way that Klarna makes money on the back of that is that they charge merchants fees for those transactions. And so the take rate is the amount of fees essentially there that they're generating. Now, the average take rate for Klarna at the moment is 2.54%. That's up from 2.33% from the first 6 months of 2023. So effectively, the two key kind of metrics for Klarna is this, gross merchandise volume, which is, how much stuff can we help retailers sell? That's the total amount of goods that are purchased through Klarna effectively. Now, obviously, the retail partners that are selling that stuff get the majority of that money, and then Klarna takes that 2.3% off the back of those sales. So Klarna's goal, obviously, is to help these retailers to increase sales so that share of income that they generate or their take rate increases over time. So the key for Klarna effectively, right, is like merchant expansion. One of the ways to increase the amount of gross merchandise volume that you move or the stuff that you sell is to have more and more stores offering Klarna as a payment method. And we can see that they added about 70,000 merchants in the US over the last 12 months. And that's helped them to generate that kind of 38% revenue growth rate in that market. So Sweden is the kind of home base for Klarna. And they report that 3/4 of adult Swedes are active Klarna users, right? So just like phenomenal market penetration from them in their home market. You've got 3/4 of consumers effectively using your services. That's incredible. And then on top of all of this, the other thing I like about this Klarna story is that they're just doing a really good job of staying relevant, right? Of like generating earned media. So this is this podcast has been running for 13 weeks. This is the second major story that we've had on Klarna in those 13 weeks. And this is for a company that has like a fairly small global footprint, right? They're doing a couple billion in revenue. They're not strategically important, right? They're kind of this like consumer app, but they find a way to stay relevant and in the news cycle. And as a CEO or as a public company CEO, that's one of the traits that you probably want to look for, right? It's like, how can Klarna stay relevant so that retail investors are invigorated and want to invest and get behind the company? So yeah, I think the CEO there is doing a masterful job at kind of staying front of mind, building hype, building awareness, building momentum as they look to kind of further into the US and then eventually go public. So news came out last week, I want to say, that Salesforce is hiring 1,000 salespeople to sell its AI agent called Agentforce. So Bloomberg reported earlier this month that, they have plans to hire 1,000 sales reps to help enterprise organizations to automate workflows. Now, the irony of Salesforce hiring salespeople to sell AI agents designed to replace salespeople, among other things, right, was not lost on the internet. A couple of awesome tweets I found here. So hire 1,000 salespeople to sell an AI tool that should or would replace salespeople, right? Salesforce, please. And then if Salesforce can't use its own AI tool to sell its own AI tools, then how good is the AI tool? And then this one here is kind of my favorite. And in other news, Salesforce is hiring 1,000 salespeople, handing them shovels and ordering them to dig their own graves. So yeah, this is obviously interesting. I think a little bit tongue in cheek. I think Salesforce would just clearly say that these agents aren't designed to replace people, right? We're still going to need people to execute the activities. The agents are there to kind of optimize workflows that can be optimized, at least at this point in time. The way that Salesforce talks about these is that unlike traditional chatbots, Agentforce uses advanced reasoning abilities to make decisions and take actions such as resolving customer cases, qualifying sales leads, and optimizing marketing campaigns. Now, Salesforce is obviously hoping that this is going to be the growth catalyst, right, that they're looking for. So ARR growth for Salesforce has slowed considerably since kind of Q2 of 2020, when they were generating about 30% ARR growth, right? Fast forward to Q2 of this year, and that was down to just 9.5%. So they've really had trouble growing top-line ARR. They've invested a lot of time and energy in this AI agent solution being kind of like the future of the enterprise, right? This was the topic of Mark Benioff's keynote at Dreamforce this year. So they are kind of going all in, moving all of the chips onto this side of the table and saying, this is the future. We're going to be the leaders in this, and really putting their money where their mouth is now. So if we look at those 1,000 salespeople, right, that's going to cost Salesforce probably somewhere around $150 million a year in order to employ those people, right? So it seems like a lot, but for Salesforce, that is really a bit of a drop in the bucket, right? So in Q2, Salesforce spent about $3.2 billion on sales and marketing. So, $150 million a year probably isn't even going to show up on the income statement, but I think it's not just the hiring of the salespeople that's the story here, but it is that the focus or the complete narrative shift that Salesforce has around this is the future, right? This is where enterprises need to go to, and we're going to be the company that helps them to get there. There are obviously massive tailwinds in this sector, right? AI hype is real, but Salesforce is competing against some pretty strong competition here, right? Obviously ServiceNow has gone into this in a big way, and Microsoft as well with their kind of Copilot offerings. So this is a market that we're going to keep a close eye on, and we'll see how this develops over the next few quarters. So Klaviyo CEO Andrew Bialecki was interviewed at SaaStr this year. He had a really good conversation with Jason Lemkin talking about how Klaviyo went from kind of tiny SaaS startup through to multi-billion-dollar public SaaS company. And I want to give you some of the key kind of insights or highlights from that interview. But first, just a quick recap on where Klaviyo's at as a business, right? So as of Q3, so they've released Q3 earnings, so we'll cover that in detail next week. But as of now, they're doing just under $1 billion in ARR, growing at 33%. They've got a magic number of 0.55, CAC payback of 28 months, and free cash flow of 15%, right? So just doing a great job across kind of all of the core SaaS metrics that you'd want to see them performing on. But it's the story behind these numbers, I think, that's interesting. So before Klaviyo, B2C businesses had a really hard time managing first-party data, right? So for example, let's say that you ran a retail store, whether that was kind of like e-commerce or a physical store, and you knew that you had a bunch of customers that had, let's say, bought jeans from you before, but had never bought any of your shirts. Right? So before Klaviyo, it would be very hard to sort. You would likely have the data in your business somewhere and somehow, but it would be very hard to be able to sort, okay, who has bought jeans from me but has never bought a shirt before? And so as small business owners, right, these people wanted to be able to target or to market to these people specifically and run segmented campaigns along those lines, right? But it was very difficult to do it. It would take them weeks to pull that data together to find that segment of customers that fit this promotion that they wanted to run. So Klaviyo came in, and what they said, or the initial kind of promise, was that we'll make it really easy to segment your customers so that you can run the promotions that you want to run and sell more stuff, right? So rather than this taking weeks to achieve, right, we'll help you do it in 2 minutes. So the key kind of insight here is that, they identified an initial problem that they could really go in and solve for their customers that had an immediate impact on the business, right? If it becomes much easier for me to run these campaigns, then I get immediate value from purchasing this solution, right? I don't have to go and muck around in spreadsheets and try to run exports from my different databases and then upload that data into MailChimp and then run different campaigns, right? I've got one place that I can do it all from. That saves me a bunch of time and hopefully makes me more money on the back end. One of the first things that Andrew points to as being a big boost to Klaviyo early on was the partnership that they were able to establish with Shopify. And in the interview with Jason, Andrew breaks down some of the more tactical things that they did in order to get that partnership, right? So at the time, what they found was that Shopify customers were actually a great fit for their solution, right? They'd talked to a bunch of Shopify customers who had the problem. They'd solved the problem for them and had found that the customers really loved Klaviyo, right? They really loved the tool, and it really helped them to get more out of not just, Klaviyo, but also from their existing Shopify subscription as well. What Andrew talks about here is as an early stage company, if you're trying to build partnerships with a more established business, then rather than just going to this potential partner and saying, hey, here are all of the cool things that we could do together, here's how we could help you, and in return, here's how you could help us. What he says instead is just go and do the work and then go to the person and say, or the potential partner and say, hey, look, here's what we did, right? So what they did is they went and found a bunch of Shopify users. They helped them get Klaviyo installed. They helped them get really good results from Klaviyo. And then now they can go to Shopify and say, hey, look, here's 20 of your customers. They absolutely love working with us, right? Here's their contact information. Go and get in touch with them. I'm sure they'll tell you the same thing, right? And what that does is it makes the outcomes a lot more tangible, right? Rather than them having to think through, okay, could this work? Now, how do we apply resource to this? It's just no, we'll solve a problem for you, right? Your customers are struggling with this. We can do that for them. And that solves a real problem that Shopify, other Shopify users have. And Shopify is now much more motivated to help you to win as well because you're helping their customers, right? So instead of trying to, theorize around how you can help someone, just go and do the work first and then go back to them and show them what you've done. That's a much more effective way to generate a partnership when you're looking to partner with someone that's kind of further along the path than you are. The second interesting insight from the interview was the decision that Klaviyo made pretty early on to focus on being a vertical solution. So if you think about Klaviyo, they're basically just a customer repository for a B2C business, right? So it takes all of your information around your customers and then allows you to segment those customers based on that information, and then allows you to communicate with them, whether that's through email or text, right? So that workflow could be applied to any business that has, B2C consumers, right? So any B2C business essentially could be a Klaviyo customer. But by focusing on a specific vertical, it allowed them to go much deeper and solve much more valuable problems, right? And so the way to think about this is that like the way that a clothing retailer wants to use customer data and how they can action that customer data is probably a lot different than the way that a hotel would want to use that data or a car retailer would want to use that data, right? If you're a clothing retailer, you could send really transactional emails that someone takes action on and purchases straight away. If you're a hotel, right, it's unlikely that you're going to like prompt someone to purchase a stay with you now based on an email that you're sending, right? The outcome or the goal of marketing and customer segmentation is probably a little bit different. So by focusing on one specific vertical, which is like retail initially, they were able to go much deeper into that vertical and solve the core problems for that core customer. And one of the key things that they did here was that they changed the performance tracking across their email marketing away from kind of the traditional email marketing metrics, things like open rate and click-through rate. And they changed the core metric to be how much revenue did this email campaign generate, right? And so now straight away, like how effective the campaign was based on the actual outcome that you're trying to generate, right? Which is more revenue for the business. They probably can't build that feature if they're selling this customer management and email solution to hotels and to car dealerships and to restaurants, right? Because like the purchase cycles are different, right? And so the idea of an email driving revenue is less relevant to these different businesses, right? And so again, by being able to niche down and be specific, they're able to drive much better outcomes for that customer cohort. The third interesting insight from this interview was this concept that Andrew talked about around going from big to niche as opposed to niche to big, right? So when you're looking to start a company, often what people tell you or the advice that they'll give you is go and find a specific problem and solve that problem for that type of customer, right? And so the way that Klaviyo could have started was they could have said, hey, we've talked to a bunch of Shopify store merchants, and what we found is that it's really hard for them to segment their customer base and then send targeted marketing emails to that customer base, right? And then Klaviyo could go in and build that solution and then continue to build out and expand from there, right? So that's one way to start a company. The thing that you have to think about in this model is like, is there enough room for expansion past that core idea, or is that core problem that we're solving initially, is that big enough to help us get to scale so that we can get to the next thing? So you kind of always need to keep your head up to make sure that you're solving something that's large enough to create a business around. The way that they started Klaviyo was actually in reverse to that. So what they did was they started out with the big idea and then niched down. So the big idea for Klaviyo was that they wanted to be the place that you store all of your customer data, and then Klaviyo will allow you to then use that data to get things accomplished, right? Whether that's inside Klaviyo or that's through another tool that Klaviyo connects with, right? So that was their big vision, is like, we're the home for customer data, effectively. Now, Amazon started in the same way, right? Jeff Bezos had this vision for like Amazon being the retail store of the future, driven by the internet. But what he happened to do was he started off by just selling books online, right? So books weren't the like eventual goal. The idea wasn't just for Amazon to be a bookstore, right? But that was the starting point for them to then expand out. And so Klaviyo's was the same way, right? They had this bigger vision, and then what they did initially was they tried to find that little wedge or that little entry point or that first problem that they could solve to get that bigger vision rolling, right? So that's another way to think about kind of like idea generation, is that you don't have to start small and work out, right? You can start with a bigger concept initially and then niche down to kind of like find the initial entry point into a given market. All right, that's it for this week. Thanks for tuning in. One favor, if you've been watching these and you haven't subscribed yet, if you could do that, that would be awesome. And as always, if you have any feedback for me, any advice, anything you want to hear me talk about, let me know. I'm always keen to kind of try to make this more interesting, more informative for you guys that tune in. So thanks a lot. I hope you enjoyed the show. I'll see you next week. Until then, goodbye.